Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins-Hutton, the Director of Investor Education here at PassiveInvesting.com. And today with us, we have a special guest, Karl Krauskopf. Karl, welcome to the podcast.
Thanks so much for having me, Whitney. I'm super excited to be here.
Awesome. Well, before we dive into your transaction today, which is the Evergreen Apartments, a 30-unit complex in Wenatchee, Washington, tell us a little bit about yourself and your background, how you got into multifamily and where you're at today.
Sure. So Karl Krauskopf, I live in Seattle, grew up in Florida, and I spent about 10 years in the corporate world in business strategy and corporate development for a healthcare business services company. Transitioned from corporate space into real estate when I realized I had a ceiling in terms of my salary and my ability to create wealth. Initially started off flipping homes, flipped about probably close to 20 over the course of a 2 to 3 year period. Got into infill development as I started organically growing an investor group. And from there, we saw the writing on the wall this October 2021, when inflation data started coming out. We realized the likelihood of rates going up and the residential market starting to go south was probably impending. So we did a lot of self-education around how to get into multifamily, how to manage the asset and acquire and effectively get to the disposition position. So multifamily is now the focus. We love the 20 to 50 unit range, just seems to be a great buyer pool on the back end, and really looking forward to continuing to grow the business.
I love that range because that's often kind of called the missing middle, right? It lends well to all cash transactions from some larger, smaller buyers.
Right.
That's a way to put it. But you're not really competing with the institutional grade buyers. So I love that. Well, let's talk about your deal, the Evergreen Apartments or Evergreen Court Apartments in Wenatchee, Washington, that 30-unit complex. Let's dive in. So you closed in October 20.
October.
Yep. All right, so let's back up the timeline a little bit. How did you find the deal? When did you find the deal? Just kind of walk us through that developing timeline there.
Sure. So back in, I want to say spring of 2022, so just a little less than a year ago, again, that was where we started really underwriting, really submitting LOIs and purchase agreements to properties here in the Washington state. Why Washington state? It's our backyard, essentially. We know it, we love it. We can really get in and dig in with brokers. We've got the relationships from the contractor team. So we felt really, really confident in moving quickly into the Washington state space. Again, had some relationships with commercial brokers at the time, and really where I went and what I valued was the broker relationship. So we worked with our brokers to help us craft a buy box for us. One in particular reached out, and we had worked with them on 2 other letters of intent previously. So in the spring of 2022, and around the June timeframe, maybe May of 2022, he reached out, hey, we've got an opportunity coming up in Wenatchee. I think it's got some good legs, and the seller is motivated and wants to sell this place. He tried to sell it years ago, couldn't make a sale for one reason or another, and he's coming back to the market now. And so we did some heavy evaluation, both market standpoint as well as the assets, and really understanding, again, where is it operating right now? Where can we take it to? And obviously all of the details in between. So this was June, kind of led us into the June timeframe prior to submitting the formal offer.
Okay. And so at what point in time did you visit the property, and what kind of class of property is it?
Sure. Good question. So this was 1927 built, Class C building in what I would say a Class B area, B neighborhood. We're right in the downtown core of Wenatchee. From a walking distance perspective, we were pulled away from the main commercial drag of Wenatchee, which really allowed for really high walk score, which we valued for the residents, especially with where we wanted to take the property. With one of the assets we could talk about, a parking lot, a separately deeded parking lot that we want to either develop or sell out to a developer. So we figure with that high walk score, we're going to still be able to maintain a good tenant base within the apartment, even after we sell the parking lot.
Tell me a little bit about, I'm not familiar with Wenatchee. Tell me a little bit about, the fundamentals of the market.
Sure. So Wenatchee is coined the Apple capital of the world. no joke. When you come into the city, they've got a mega apple, billboard style apple that again displays this prominently displayed name of apple capital of the world. So it's heavy agriculture. It's got a lot of manufacturing and industrial. It's the largest city in central Washington and really is seen as the gateway from that bridges the west side of the mountains. So think of Seattle, the Puget Sound region, to eastern Washington, which is Spokane. And then you get into the Coeur d'Alene, Idaho, and other parts of the eastern Washington state. So, central Washington, again, the majority of our tenant base is mixed in the agricultural space. And we thought, going into this purchase, especially with rewinding back to June of last year, with inflation, impending recession, all of the headliners of what was going to be coming, we looked and we figured two really great and strong fundamentals about this property and this market is higher agriculture. We thought that even with the recession, that we're still going to be needing a high degree of food. Food prices were increasing. And then second is energy. Chelan County, which is where Wenatchee is based, has one of the cheapest electricity rates in the country. So we figured, between a strong employment base as well as inexpensive living costs for tenants, gave us a strong hedge against vacancy.
Interesting. All right. Yeah. Thank you for kind of giving us a little bit of a lowdown about the area. Okay. So you had the property. Were you competing with other buyers?
No. So this was an off-market property. Again, this property went on the market a year or two before. I'd gotten vetted. They were asking, I think, about closer to about $500,000 above what we ended up closing on it for. Again, they started seeing interest rates are going up. We want to get out. We want to reposition capital.
Okay. And so what did you actually close the property at?
We closed it at $4.3 million purchase price with a $100,000 credit to closing.
Okay. And so 4.3, so they had it listed closer to 4.8?
Yes.
Okay. So off market, you guys put it under contract. Talk to me about how you structure the offer and when you actually step foot on the property.
So we stepped foot on the property before we got a signed PSA, a purchase and sale agreement. Wenatchee is about a 2-hour drive for us. My partner owns property in the Wenatchee area. So we frequent the area often. So we decided to take a drive prior to submitting the PSA, really get a good walkthrough of at least the systems, as well as a couple of the vacant units, just to get a good sense. Yes, does the offering memorandum, the broker's offering memorandum, does it match what we see? And surprisingly, it did. The exterior of the property was just as pristine as the high-res photos. Really well maintained building for how old it was.
Fantastic. Okay, so how did you structure your offer in order to get that discount of $500,000 and your $100,000 credit towards closing? How did you bridge that gap?
So keeping in mind that they originally had it listed for 4.8, and at the point that they were trying to sell it for 4.8, this was in a much stronger seller's market. So now that some of the market dynamics have shifted, that's where they started saying, okay, we'll take 4.4, 4.5. And then we came in, we said, look, we've got a lot higher vacancy rates than what we expect. You have an increased rent, which gave us some opportunity on the back end. And, going through a lease audit, we found a lot of challenges with the tenants, being that under-collected deposits, pets that were not part of the lease agreements were there. And so we knew that we would have kind of an uphill battle to go through, which we could talk about later. But on the credit side of things, we did an inspection, a very thorough inspection. Now what we're doing on some of our other acquisitions is we're bringing our general contractor, our subcontractor team, and we're getting walkthroughs from them. On this property, it was a formal inspection company. They prodded every single corner of the property. We got sewer scopes. Sewer scope was one of the main opportunities that we found to be able to leverage and get that credit.
What was wrong with the sewer?
So sewer line was clay pipe. So again, super old property, and there were root balls absolutely littered throughout the sewer line. So we offered to do, there were some, what we originally thought were foundation challenges as well via stem wall, but our foundation company from Seattle come out and they poked it and they said, look, guys, this actually isn't the stem wall. This is just a bulging sheetrock issue. So instead of a $75,000 fix, now we're talking about a very minor sheetrock issue plus some surface water issues that we had to resolve. But that being said, in totality, the $100,000 fix that we expected ended up costing us less than $20,000 after we closed. That is, yeah.
That's a nice pickup. Okay, so you talked to us a little bit about your due diligence, but like in the offer, like how did you structure it? Did you have like 2 weeks, 3 weeks, 4 weeks for due diligence? How much time then for closing?
Sure. So we did, yeah.
There.
So we did a 30-day feasibility period, which again gave us full reign of the due diligence, lease audits, inspections, part of the capital raise as well. And then we had an additional 60-day finance contingency. So, again, going into the property, we knew this was an aged building. We had some lease challenges to resolve once we took ownership, and we figured that the appraiser had access to these leases and that could impact to some degree the valuation of the property. We wanted to make sure we had a strong ability to either negotiate on the back end with that finance contingency, or at least an opportunity to get out should something go completely awry. Again, at this point, we were in late July, early to middle August, where we were operating within that finance contingency. But we ended up locking interest rates at 4.7, which we were super stoked about, 5-year fixed and 30-year amortization. So really excited about that loan, excited about that debt. And we closed 7 days after we waived the finance contingency. So a total of about 100 days.
So what kind of earnest money did you put down, and if and when did any of it go hard?
Sure. $50,000 earnest, and that went hard after the finance contingency.
Okay. So this is the question that a lot of people that are getting into multifamily investing, ask themselves, where am I going to get the money for the earnest deposit and for all the due diligence and everything like that? Talk to us a little bit about that. How did you precede that?
Sure. So we fund all of the earnest money, the risk capital ourselves as the managers, and other ways that we've explored is partnering up with, whether it's another general partner or a money partner, so to speak. Obviously we're indebted to them if something goes wrong. But, from a due diligence standpoint, the costs there associated with attorney fees, a lot of that stuff ends up getting reimbursed on the back end once we close. But some of the inspection, right, we had another property around the same time that we were under contract on. We performed something around a $7,000 inspection on, and a lot of things came up during the due diligence, and we ended up asking for a pretty substantial haircut. This is, again, another property, but they declined it, and we figured it would be more worthwhile to, write off that $7,000 inspection cost than to move forward with the transaction. So, that was our $7,000, and, that's part of doing the business.
That's a lot of the reason why there is an acquisition fee on the front end closing on these properties, because it helps repopulate the coffers, so to speak, and cover all the additional costs for those properties that you didn't close.
Right.
All right. So you're going through due diligence. You see the foundational issues. You see the sewer scope issues. You know about the challenges with the tenants, rents not being bumped, pets on the property, just a little bit, may I say, mismanagement there. Were there any other surprises as you went through the due diligence?
Positive surprises.
Yay. Let's talk about those.
Yeah, positive surprises. So the acquisition, again, it was a 30-unit apartment complex, but rather it was actually spread over 3 different parcels. So we had a 24-unit Bavarian style garden apartment, absolutely gorgeous, pristine condition. Next door to that was a 6-unit cottage, again, separately parceled. And the 6-unit cottage was made up of 4 individual homes, so 4 detached homes and a duplex. And then the third would be a parking lot. We originally had the idea of selling off or developing the parking lot and potentially selling that cottage project separately. But from an underwriting standpoint, we just assumed it was all going to be sold at the end of the whole period. And one of our partners on it, so it's my business partner within Aurora's investment group, and we had another co-GP who helped from a guarantor standpoint. Really, really smart guy. And what we put together on the plan with the cottage project was to do a short plat stand up a homeowner association. So effectively to create 2 homeowners associations for each of those new short plats on that 6 unit, and then sell each of the homes separately to homeowners, right? So that way our cost per unit or cost per door would be significantly higher selling to a homeowner rather than to an apartment investor, especially at the end of the 7 to 10 year time frame.
Is that different than trying to get individual tax parcels for each one of those?
So that would be, so we wouldn't be able to do that just from a zoning perspective and setback perspective, but the idea is effectively the same.
Interesting. Very cool. Very creative. All right. So you helped me segue into like, how did you structure the deal? And let's first talk about the partnership. So you had 2 other partners, your partner, and then it sounds like a key partner in the deal. So talk to me, please share whatever you're comfortable sharing of how you guys structure the GP shares.
Sure. So this was a 70-30 LP-GP split, 70% to the LPs, 30% to the general partners. And from a general partner standpoint, this was comprised of Aurora's investment group, which is my company, and our key partner. And between the 2 of those, we did a 25% split to Aurora's investment group and a 5% split to the key partner. And the key partner's responsibility in this case was helping us to obtain the loan, both from not really from a net worth perspective, but more so from a global cash flow perspective. Again, kind of rewinding to my bio. This is now full-time year 2 in the investing space. So didn't really have the history from a global cash flow perspective to substantiate the purchase.
Okay. All right. Well, and everybody has to get started somewhere, right?
Yep. Absolutely.
Again, very creative. Before we move on to how you structured the offer for the limited partners, I want to touch on the financing. So walk us through the capital stack. And you already said that you got a loan for 4.75 fixed for 5 years, but dive into, was this from a bank, a private REIT?
Sure.
Give us all the details on the lending.
Sure. So we have a credit union partner from a debt perspective, STCU, Spokane Teachers Credit Union. Shout out to them. They were great. They took us from start to finish. They rate locked us at 4.7. The loan proceeds are, I believe it's actually $2.75 million. So the loan itself, the loan balance is $2.75 million up to $3.25. So we've got a $500,000 rehab allocation. So this is a rehab loan, which is great. We've got a strong 18-month interest-only period. So let us get to a stabilized position. We have an earnout as well. Earnout is part of this package itself. And at the earnout is, we originally, again, projected an 18-month stabilization period, but we've done some really creative things separate from the cottage sellout. We've done some creative things with quickly renovating and quickly bumping up rent, where we think that will actually be stabilized in less than 12 months. So super excited about that. But from a capital stack perspective, again, we're at about $2.75 million from a loan perspective, and we ended up bringing in $1.2 million as equity into the project.
Fantastic. Okay. And then were there any lockout periods on this to prepayment penalties should you want to sell early?
I think if I remember correctly, it's probably a 3-2-1. So a 3-year prepayment year 1, 2% year 2, 1% year 3. But what we did is we structured on the front end the partial release and sellout of a portion, i.e. those cottages. If we do sell that within the first 3 years, there's no prepayment penalty on that.
Fantastic. And so was that something they offered to you, or something that you had to ask for
Yep, we had to ask for it.
And did you get any pushbacks?
Not too much, not a substantial amount. I mean, obviously it's walking through the business plan, why this makes sense for them, de-risking their balance sheet as well as ours, and then really identifying, hey, look, the 6-unit cottage is not the core asset here. It's the garden style apartments.
Awesome.
And I think their biggest pushback actually was releasing or selling the parking lot separately. So
tell us more about that.
So even though they're separately parceled, zoning does not require the apartments to have any parking because, again, where it's located from a business standpoint. And so the lender wants to see, hey, it makes sense. We don't want your rents to slump, even though we're charging separately for parking. We don't want to see the rent slump because of the loss of parking.
Is the parking lot right next to the building?
It's across the street.
Across the street. And so it's being utilized by the tenants.
Some.
Okay.
So there's roughly 20, let's call it 24 parking stalls in that lot. And right now it's only 6 cars that are renting spaces. And so something interesting is, every time I've gone there in the past, it was, even though we had 6 rentals or 6 slots being rented, there would be like 12 or 15 vehicles. We knew there was an issue, whether it was tenants or neighbors or whatever it happened to be, just an overutilization of it. And what we ended up doing is installing security cameras, getting permits for the folks that were actually paying for the slots, and going into effect right now in terms of, okay, we've given you 2 months operating within the permits. If we catch you parked here, we're going to end up towing. So,
is there an opportunity for you to increase income or add additional streams of income and rent those additional slots to other people that are traveling to the downtown area?
Outside of the tenant base? Mm-hmm. I'm sure that there is, but, I'm curious in terms of any kind of liability. Say if someone rents it and, there's the short-term rental, right? So you see the sign, $6 for 4 hours. I think that style probably wouldn't be so interested in, again, just from a liability standpoint, with tenants being there as well as the short-term renters. But certainly long-term parking rentals, I would think, would have less of a liability. But, I think that's a really good that we haven't investigated, that I'd love to do that.
Oh, interesting. Okay. Well, we got off track with the parking lot, but let's bring it back on track and talk about the additional raise of the capital, from your investors. And you said it was about 1.2, 1.3, somewhere in there?
So it ended up being 1.2 for the equity portion of the apartments, around $100,000 for the closing costs. And we had quite a bit on the rehab side, operating reserves, as well as the sponsor fees.
And so what was your total raise then?
We ended up raising 1 3/4, so 1.75 million.
1.75 million. Okay, so typical split, 70-30, 70% to the limited partner investors. Walk me through how you structured that waterfall for the investors.
Sure. So we're giving a 8% preferred return. We don't have any hurdles on it. So it's straightforward, straight down the line, no hurdles. The investors, 70-30 split, no hurdles, 8 pref. And what we're doing is we're not taking anything below the line aside from asset management, which I want to say is 1.5%, and 1.5% asset management fee. And from a sponsor fee perspective, we're not getting any of our project management fee until the stabilization hits, until we're able to get to a stabilized and cash flowing position.
Okay. And then what about a disposition or a capital event fee?
So great questions. And no, we're not including any either of disposition or capital, any kind of refinance fees either.
Okay. So talk just a little bit after takeover. You close on the building and everybody celebrates. Maybe there's a bottle of champagne that gets popped. Tell us about your first few days after takeover.
So we took over I think it was October 14th of 2022. The first thing, we had 2 main priorities for the apartments. It was to winterize, so get the property prepared for winter, which involved making sure that we had the appropriate contractors ready for snow removal, making sure that we had a roof, I don't know the exact term, but effectively the objects that go on top of the roof that prevent over buildup and big snow slides. Because again, Wenatchee is on the east side of the mountain, so they get a lot more dry, effectively a lot more snow. And then besides the winterization, is we wanted to get the general and the community areas really spruced up. Not that they were in poor condition before, but we wanted to do effectively a light and quick facelift. So getting in, fixing any of the deteriorating drywall, like what I was talking about earlier, that we thought it was a foundation issue. There were some missing tiles here, there, and everywhere. There were light bulbs. One of my biggest pet peeves is when you walk some of these apartments, kind of older vintage apartments, and you've got a 3000 Kelvin light bulb that's really yellow, warm tone. And then next to it, you've got a daylight bulb, and none of the lighting matches. And so that was the next move, was to get all of the lighting package updated, and then improve security around the facility. So adding additional exterior floodlights and lighting around the gated entry.
Fantastic. Fantastic. Was there anything, just kind of wrapping up, was there anything that what you thought was going to be easy that was hard? And was there anything that you thought was going to be hard that actually ended up being easy?
So I think I thought that was going to be easy, but ended up being difficult was getting the storage. So the property came with storage, getting the storage and the parking rented out. So boosting our other income bucket as quickly as I had hoped for. Not that we underwrote it in a drop dead day one or even within the first year that we were going to be fully occupied from an other income standpoint, or rather run rate, but it's taking a little bit longer than I had optimistically hoped for to get storage aligned and those additional parking spots aligned as well. Something that I thought would have been hard that ended up being easy is the rent increases. So, I think the majority of the folks knew that they had effectively a sweet deal from a rent standpoint. They saw new management's doing a lot of improvements. We improved the laundry facilities. They had washing machines that just constantly were breaking. So we went in, we updated all of the washer and dryers. So that way, again, trying to reduce the majority of the complaints or issues or recurring issues that the tenants had. I think was something that I thought was going to be hard, but was really easy to do on the front end.
So just a side question, did you do all of those improvements and then ask for the rent bump?
No, we did it. And so let me back up. We did the majority of the improvements prior to the rent bump, but we're still doing some of the laundry facilities came after the rent bump. The lighting package, new carpet throughout the common areas, new paint in the common areas, retiling some of the common areas. That stuff came before the rent bump.
So they could see the perceived value that you're asking for. Awesome. And that you're improving their community. That's amazing. Yep. Well, Karl, thank you so much for joining us today, sharing your knowledge and insights here with us. If a listener wants to reach out to you and get to know you better, where can they find you?
A couple places. So my favorite place is LinkedIn. I try to add value back to the community through macroeconomic updates as well as project updates there. So it's LinkedIn /Karl-Krauskopf. And we've got an Instagram handle at Aurora's Investment Group and our website, aurorasinvestmentgroup.com.
Excellent. Well, Karl, thank you for spending your time with us here today. We look forward to hearing from you on future acquisitions.
Excellent. Thanks, Whitney.